With time running out for a breakthrough on the Brexit negotiations, the threat is that when the big EU meeting occurs later this month, there will be no green light to move on to the next stage. What do economists make of all this and the effects on the British economy? Paul Hollingsworth joins us now from Capital Economics with some more on this. Let's take a look at where we are on the Brexit negotiations. It seems like we are at a point where we're not going to get any further. Or do you think ultimately we'll get some sort of last-minute fudge?
I think it's quite possible that we do get some sort of, like you say, last-minute fudge. That's often the case with these sorts of negotiations. I think it's going to be quite a close call, though, whether we do make sufficient progress in order to move to the sort of second phase of the negotiations. That's the trade talks and talks about a transitional deal. Now, the 15th of December is that key date. That's when the European Council makes its decision on whether we've got to that stage. And clearly, at the moment, there's a lot of uncertainty, particularly on the Irish issue of avoiding a hard border there. And it's really about the wording. It's the wording of the draft agreement that I think is the sticking point at the moment.
The Irish border, as you say, is obviously a big issue. We've got a lot of political interest there on both sides of the border and, of course, across Europe as well. There are some suggestions within the right-hand end of the Brexit end of the wing of the Conservative Party, Jacob Rees-Mogg particularly, talking about no need for a border at all. If the border needs to be put there, it's up to the EU. So far as the UK is concerned, we don't need a border. We would rather have free trade, frictionless trade across the European Union. That sounds like a pretty good deal to me.
Yeah, I mean, on the face of it, that sounds like an ideal solution. We just say, well, we're not going to do one, so it's up to you. But in practice, that doesn't really work, particularly if the UK ends up operating on World Trade Organization rules, then it has to apply the same, it's called most favored nation status. So you can't give preferential treatment to one country, but not another country. So we couldn't just say there's going to be no controls, no checks, no border between the Republic of Ireland and Northern Ireland. We'd have to give that same treatment to all other countries. So that's not really a sort of workable solution. And of course, the reason for a border, or the reason this came about, is because of the UK's decision to leave the EU. So it is sort of in the hands of the UK to really deal with this.
Yeah. Let's assume that there isn't a fudge. Let's assume that there is ultimately going to be a big insurmountable difference that we go forward on, and come March 2019 we have nothing to put forward. Cliff edge, I think, is what it is, isn't it? What happens to the British economy? How should we be preparing for this in the lead up to that?
So I guess firstly, just to break that down a little bit, clearly the 15th of December is this next key date.
That's the EU
and that's the European Council meeting, exactly. And if we don't make sufficient progress at that date, then we're going to have to wait until March. So March the 22nd and 23rd, that's when the next European Council meeting is. So that pushes back that potential sufficient progress point until March. That very severely limits the time left to negotiate. But I think what we need to remember is that these negotiations are split into two phases. It's the withdrawal agreement is the first phase, and then the second phase is about that future partnership. Now, in terms of the Article 50 text, it says that we need to conclude the withdrawal agreement taking into account the framework for a future agreement. So what it could be is that actually we get quite a last-minute deal on the sort of withdrawal phase of things that allows us to say, okay, well, we're going to have a transition for 2 years that's going to mimic exactly what we have now, and that actually extends the sort of time frame allowed to hammer out the details of a future agreement. And I think that's quite a possible scenario. Clearly, there is still a significant possibility that we just don't make sufficient progress, and that deadline keeps getting pushed and pushed and pushed until, like you say, we get to March 2019 and we do face the so-called cliff edge. I'm not sure whether the government would be able to get that through the Commons. I think that would be incredibly difficult from a political point of view to even get to that stage. So it's quite possible that within that period, there is another general election. We potentially get another government or a change in leadership that potentially ends in either an extension or a revocation of Article 50. There's clearly uncertainties whether that would be allowed. It would be up to the EU to decide. But I think we might get to that stage before we get to 2019.
In the interim, what do we make of the projections for growth, the OBR recently, which again, some in the Conservative Party saying it's overly pessimistic. OBR growth, for 1.5% this year, I think going down to 1.3% over the next year or two for growth. What happens to the growth picture ultimately if we don't get if we don't clear the hurdles, the 15th of December, the 22nd of March and so forth? Do you see growth slowing down even more? And what for inflation? Because inflation is driven in part by what's happening with sterling. If you get lower growth, you get lower sterling, which imports more inflation. Economically, it's becoming a very interesting picture.
Yeah. So firstly, it's worth saying that those forecasts are based on a fairly kind of neutral Brexit assumption. So the OBR, its newfound pessimism on the UK economy isn't because it's changed its view on what the effects of Brexit are going to be in the near term. That's more to do with its assumptions about productivity growth and the sort of long-run potential of the economy. As it happens, I think that those forecasts are potentially a little bit too pessimistic. But putting that aside, they're assuming essentially a sort of average of a range of possible Brexit outcomes, like I say, a fairly neutral assumption, and within that there's clearly a huge scope for things to be significantly different. Now, since the referendum, the economy has actually held up much better than people thought, despite the fact that there was all this Brexit uncertainty. There's clearly a question of whether that uncertainty will have a more potent effect now we get closer to that day of leaving the EU. You can make the case that it's still a long way away, so firms have not really been thinking about it, but as that date draws closer, firms actually start executing their contingency plans, and we're already seeing signs that some firms are moving business abroad or putting in forwards those contingency plans. So it's possible that if we don't meet this December deadline for sufficient progress, that gets pushed to March, and we don't make that March deadline, that actually that uncertainty does have more of an effect on the economy. We could see it weighing a bit more on investment than we've seen up until now. But assuming that we do make sufficient progress, either in December or in March, even if we don't have the full details of any future agreement, I think what businesses are looking for is clarity on the transition deal. And if they know that actually we've got 2 years where it's going to be business as usual, then that should prevent much of a slowdown in the near term.
And then what happens to sterling in that period? What happens to the inflation factor?
So clearly it's going to depend hugely on what happens to the exchange rate. I think our central scenario is that we do start to make progress, we do get some clarity on the transitional deal, and assuming that, then we shouldn't see too much impact on sterling, and actually we might see a bit of a shift away from what's happening on Brexit and towards the Bank of England and what's happening with interest rate rises. But of course, if we still get all of this uncertainty about Brexit, then I think that probably pushes back the date of the next hike in interest rates and probably limits the extent to which they will rise over the coming years and shifts the focus onto the negotiations itself. We've already seen a big fall in sterling since the referendum, so I think it's unlikely that we see another sort of 10-15% fall in the pound, but certainly we could see it weaken again substantially if it looks like we are approaching that cliff edge without a deal, and the possibility of another election would probably weigh on sterling.
Lots of question marks. Paul, look, thanks indeed for joining us. Paul Hollingsworth is UK economist at Capital Economics there with an assessment of the picture as we go into the big EU, the Council meeting on December the 15th, and then of course, as Paul was saying, thereafter looking ahead to March next year as the next hurdle to clear.